Welcome to another FAR walkthrough video. I'm Logan, and in today's video, we're going to be going over adjusting notes to the financial statements to correct errors. And we're going to be doing that the super fast CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to superfastcpa.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it's free, and we will show you how to pass the CPA exam effectively and efficiently so you don't waste any time. The link will be in the description, so make sure you go check that out. Also, just letting you know, we will only be going over 5 questions in this video, whereas Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1, and just a heads up, these questions are much more conceptual than what we've been looking at in the previous videos, so it might go a little bit more quickly for this video, hopefully. So let's dive in. TechWave Innovations Inc. has prepared its financial statements, and the notes include a section on significant accounting policies. Which of the following is not a significant accounting policy and should not have been included in this section of the notes? Okay, so if you don't really know what's supposed to go in the notes, what's supposed to be a significant accounting policy, and how this works, that's okay. We're going to dive straight into the answer for this one to kind of get a base understanding of what's necessary for the notes to financial statements and what shouldn't be included. So let's go ahead and look at the answer. All right, the answer is D, the schedule for office holiday closures. So let's walk through this. The accounting policies section typically includes information about revenue recognition methods, inventory valuation techniques, depreciation approaches, and criteria for determining cash equivalents. This disclosure helps stakeholders assess the financial results with a clear understanding of the underlying assumptions and practices that affect the financial statements presentation. So basically, it's giving more context to understand how the financials got to where they are. By including them in the notes, companies provide transparency and insight into their financial reporting process, allowing users to make informed decisions. Any changes in accounting policies from previous periods are also disclosed, along with their financial impact, to ensure consistency and comparability over time. So, just from this one question, we're learning that the notes to the financial statements overall are there to kind of help give information about the financial statements and kind of the background of how things are. And something that's not really a part of this is the schedule for office holiday closures. That's something that you don't really need to put in the financial statements. You can just put that online for your company or something like that. When it comes to accounting policies in the notes, this is about how you do the accounting for the different things in your company, how you value this, how you decide this, and different things like that. That's what's supposed to be in the accounting policies portion of the notes. And with that, let's go to the next question. We're going to learn about some other things that should be included in the notes to the financial statements with the next questions. All right, here we are at question 2. The notes to the financial statements of Horizon Electronics Corp. Provide additional details and context to the company's financial position and performance. Which of the following should not have been included in the notes to the financial statements? So there's the method of calculating allowances for doubtful accounts, details of legal contingencies, new product ideas, information about related party transactions. Which one of these is not typically a note that would be included in the financial statements? Now, based on what we learned in the previous question, we probably can know that this is something that should be included. This seems like an accounting policy, how they calculate allowance for doubtful accounts. But what about the other ones? Are these necessary? If you don't know, that's okay. Again, we're going to dive straight into the answer. All right, and the answer is C, new product ideas under consideration for future development. This is something that you don't necessarily need to have as a note. Let's walk through it. New product ideas under consideration for future development are not relevant to financial statements and should not be included in the notes. The notes to the financial statements are required by GAAP and intended to provide additional context and details related to financial reporting, such as accounting policies, legal contingencies, and related party transactions. And by the way, we're going to get into a lot more detail about what should be in the notes in the next question. Information about new products or strategic plans typically belongs in other sections of an annual report, such as management's discussion and analysis, or MD&A, rather than the financial statement notes. And by the way, MD&A, if I'm not wrong, is going to be something that we cover separately in the FAR notes or the FAR blueprint. So we're specifically talking about notes such as the accounting policies or things like that. Now, new product ideas, that's something that doesn't necessarily impact the financials as they are right now. it's an idea. It's something that, maybe could affect things, but as of right now, it's just an idea. It's not something that's actually affecting the financials as of right now. So that's why there's no necessary note needed here. And again, one thing I want to point out, just in case you see something like this, the main idea behind the notes for financial statements is basically GAAP requires that certain things are disclosed in the notes. So people do notes to the financial statements because it's required by GAAP. So whatever is required by GAAP for the notes, that's what's going to be included in the notes for financial statements. Now with that, let's go to the next question. Again, we're going to learn a lot more about just in general what goes into the notes. Okay, here we are at question 3. Upon reviewing the financial statements and notes for Pinnacle Tech Industries, you have made a list of 4 things that should have been disclosed in the notes but weren't. You aren't totally sure if they are all correct, so you take the list to your manager for confirmation. Which of the following items on your list would your manager inform you is not typically needed in the notes to the financial statements? Okay, again, we've talked about a few different things up to this point. Think about what you think would probably be in the financial statement notes. You could probably figure it out already. So go ahead, pause the video, think through these different options. When you're ready, come back. We'll look at it together. And again, we're going to dive deeper into what actually goes into the notes typically. All right, the answer is C, a summary of executive team biographies. This is something that you probably wouldn't include in the notes. And now that we see that answer, let's scroll down just a little bit more so that we can see the full explanation here. A summary of executive team biographies is not typically included in the notes to the financial statements. The notes are intended to provide additional details and context related to the company's financial position and performance. Here's a detailed explanation of what is generally included in the notes. So we're going to go over here. We are going to go over typically the most common things that are included in the notes. So let's go through this. Credit risk. The notes provide information about credit risk, which details the company's exposure to potential financial loss due to the inability of counterparties to fulfill their obligations. Maturity dates of long-term liabilities. Notes disclose the maturity dates of long-term liabilities, providing insight to the timing of cash outflows and the company's ability to meet its future obligations. So again, all very important things that have to do with the money, the finances of the company. Concentrations. The notes may include information about concentrations of revenue from major customers or geographic areas. This is important for stakeholders to understand potential vulnerabilities related to reliance on a limited number of sources for revenue. Basically, if something is just all focused in one small area or one customer, that could be a risk, because if something bad happens, then almost everything that the company has is focused on that thing potentially. And then dividend payouts, information on the company's dividend policy and any declared dividends can be included to provide context for changes in equity. Discontinued operations. Notes should disclose any details about any operations that have been discontinued, explaining the financial impact and reasons for discontinuation. Future lease payments. The notes typically include details about future lease commitments, helping stakeholders understand the company's future cash flow. Major transactions, information about major transactions affecting assets, liabilities, or equity during the reporting period. That's included. Changes in asset or liability classification. If something goes from long-term to short-term, that's going to be included. Short-term risks, notes that may outline any significant risks as of the financial statement date that should adversely affect the company in the short term, or that could adversely affect the company in the short term. So again, there's a lot of stuff that could be included in the notes. This honestly probably isn't even everything, but these are some of the more common things. Basically, though, think of the notes as something there to give a lot more context on the big things that happen throughout the year and also the policies that you use throughout the year. So, the credit risk, these are some things that could affect us financially. Discontinued operations, why did the company sell those operations or discontinue them? Major transactions, some really big things that happen throughout the year. All of these things have to do with majorly impacting the financial statements and also just giving more context. So that's the idea behind notes. These are some of the most common ones. Let's go to the next question. All right, here we are at question 4. Precision Manufacturing, Inc. has prepared its financial statements and included a comprehensive set of notes. During your review, you notice that certain information appears to be duplicated across different sections of the notes. Which of the following represents an unnecessary duplication of information in the notes to the financial statements? Okay, we've talked a lot about different kinds of notes and different kinds of things that should and shouldn't be included, but what about duplication? Is it okay for things to be duplicated in different parts of the notes? What does that even mean? Is it okay if things are slightly different in different sections, like it's talking about different portions, or is it okay for it to be totally repeated again? If you don't know, that's okay. Let's go ahead and go to the answer. All right, the answer is C. The accounting policy note explains the method for valuing inventory and a separate note repeats the inventory valuation method and includes a breakdown of inventory by type. So that's something that you would not typically do in the notes. So let's walk through this. In the notes to the financial statements, duplication of information can occur when the same details are repeated unnecessarily across different sections. So this could happen if you are unnecessarily repeating yourself. Here's why C is the best option when it comes to unnecessary duplication. Repeating the inventory valuation method in both the accounting policy note and a separate inventory breakdown note is unnecessary. The policy should clearly be stated once, with the separate note focusing only on inventory details like quantities and values without restating the method. Basically, something I really want to point out here, and we'll get to this at the bottom. In fact, we'll read this right here and then we'll read the other options. The goal of the notes is to provide clear and concise information without redundancy, ensuring that users can easily understand the financial statements and the underlying accounting policies without encountering repetitive information. And with that, I want to point out one more time this word, concise. That's the idea behind notes. They're supposed to be clear and they're supposed to be concise. So you're not repeating yourself, you're not saying the same thing over and over again. You're trying to do this in as few words and as clearly as possible. So you don't need to duplicate anything. It's okay if you're talking about different portions of something, and that's what we see in these other ones. Option A, the method for depreciating fixed assets is appropriately covered in one part, and then the schedule for the depreciation is in a different part. Those are two different parts of assets. That's okay. Outlining their criteria for revenue recognition, and then talking about the revenue sources in a different note to clarify something. That's also okay. Describing foreign currency translation, and then talking about the rate fluctuations. Again, two different things about something similar, but they are two different things, different information to give more clarity on a subject. But if you are repeating yourself, doing the same thing twice in the notes, that's a no-no. You probably shouldn't do that. And you very well might see a question about this on the exam. You don't need to duplicate things in the notes. Let's go to the next question. All right, here we are at question 5. As part of preparing the financial statements for Orion Pharmaceuticals, you are evaluating the notes to the financial statements for adequate disclosure. Which of the following significant estimates should be disclosed in the notes because they are reasonably possible to materially affect the company's financial position in the future? Okay, so this is another thing that you would include in the notes, something that is reasonably possible to, as an estimate, to affect you adversely. So which one of these do you think would be something that you would include in that? We've talked about a whole bunch of different things. You might have a better idea of the notes in general by now, so go ahead and pause the video, think through this if you want, and when you're ready, come back, we'll look at it together. Okay, the answer is B. The estimated settlement amount of a pending legal claim that is likely to be resolved in the next fiscal year. This is something that you would probably put in your notes for a significant estimate. Let's walk through this. Significant estimates that are reasonably possible to have a material effect on the financial statements should be disclosed in the notes to ensure transparency and provide stakeholders with crucial information about potential future impacts. So basically, if something could happen in the future that is going to adversely affect the company, it hasn't happened yet, but it's reasonably possible to happen, and it would really affect the company. It's wise, and you should disclose those things to be transparent so people know what's coming. So let's talk about why option B is correct. The estimated settlement amount of a pending legal claim is a significant estimate that is reasonably possible to have a material impact. This is a big deal. If they have to pay money, that could really affect the company. Disclosing this estimate provides stakeholders with information about potential liabilities and helps assess the company's financial risk. Now let's talk about the other options. Option A. While the estimated useful lives of equipment are significant estimates, they are typically disclosed as part of the accounting policies rather than specific notes on significant estimates affecting the future financial position. So typically this is already covered somewhere else in the notes. Option C. Estimated cost savings from a planned restructuring that has not yet been approved do not qualify for disclosure as a significant estimate. Again, this has not been approved. They depend on future actions that are uncertain and contingent upon approval. So it's not even reasonably possible that it's going to happen. It's just maybe it could happen. Option D. The estimated future benefits of an R&D project in its early stages are speculative and not typically disclosed as significant estimates, as they involve a high degree of uncertainty and depend on future developments. So these are things that, again, you probably wouldn't have a big note disclosing these significant estimates, unlike with option B, where it was something that is reasonably possible to happen and it's gonna materially affect the company. That's when you would make a note about that. Disclosing significant estimates that could materially affect the company's financial position ensures that stakeholders are aware of potential risks and uncertainties, enhancing the usefulness and reliability of the financial statements. So, again, the overall idea with the notes is to be clear, transparent, and to give as much information as you can while being concise about what is affecting the financial statements and things that are reasonably possible to affect them in the near future as well. With that, we've learned a lot in just 5 questions, and before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics with the Superfast CPA strategy is, as you're going through the questions to learn the material, you will notice the things that keep popping up. Like maybe you're seeing a lot of questions that talk about cash equivalents or depreciation method for accounting policies or different things like that. You take a second and you notice those things and you write them down as pillar topics so that you remember them for later. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. And again, this is kind of just a summary. You might have made different pillar topics on your own, but again, let's walk through these ones together. First of all, notes to the financial statements should clearly outline the significant accounting policies used in preparing the financial statements, such as methods for depreciation, revenue recognition, and inventory valuation to ensure transparency and consistency. So again, accounting policies, that's a big deal. And then overall, it's essential to include relevant information such as accounting policies, we already said that, significant estimates and concentrations, and a whole bunch of other stuff, while avoiding unnecessary or unrelated details like executive biographies in the financial statement notes. So basically anything that doesn't really have to do with the financials is unnecessary, shouldn't be in there. Next, the notes should disclose significant estimates, again we kind of talked about that are reasonably possible to materially impact the company's financial position, such as pending legal claims, to provide stakeholders with insight into potential future risks and uncertainties. Next, information should be presented clearly and concisely in the notes to avoid unnecessary duplication, ensuring that each section provides unique and relevant details without repeating what is already covered elsewhere. And then finally, notes should include information on concentrations of risk, such as major customers or geographic areas, to help stakeholders understand potential vulnerabilities and dependencies that could affect the company's financial health. So overall, it's everything about the risk and the current finances and how you got to those current finances. Anything that's not necessary or that's duplicated, you wouldn't want to have in there. And with that, those are the pillar topics, and that is the end of the video. As I wrap up this video, I just want to give one more reminder about the Superfast CPA training webinar on superfastcpa.com. Again, it's only 1 hour, it is free, and we will teach you how to be effective and efficient with your studying so you don't waste months or even years of your time. Also, just a reminder, even though we only went over 5 questions in this video, Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. Also, if you like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.